Okay. So I'm going to share my screen. Okay, you should see my screen now. You should see question 840 marks. Do you guys see that?
Yes.
Okay, cool. So I'm going to go get straight into it. I'm going to read through the scenario and try to pay attention as to what I pick up. I'll also bring it to your attention, and then we will cover the required afterwards. So they say Awesome Brand Company is listed on the Johannesburg Stock Exchange and owns and operates retail stores across South Africa. ABC sells clothing and general merchandise at wholesale prices to the public. All the companies in the group have a 28 February year end. Okay, so just a basic background. One of the most important aspects over there would be the financial year end, 28 February, which is 28 February. So they say Delicious Exotic Foods Ltd, DEF, in attempt to diversify its operations, ABC acquired 75% of the ordinary share capital and voting rights of DEF on 1 March 2018. ABC had control over DEF in accordance with IFRS 10 from that date. The purchase consideration for the acquisition was payable to the previous shareholders as follows. Before we go into there, so that sentence or that paragraph have quite a few information. So the first thing we understand, there was an acquisition where ABC acquired 75% of DEF. And that acquisition resulted in ABC controlling DEF. Now, what's important? ABC control DEF. That means there's a parent subsidiary relationship, and that means we have to consolidate. That's important. The next thing to identify is the date of acquisition, which is 1 March 2018. So from 1 March 2018, ABC have to consolidate DEF. That's very important. Also, on 1 March 2018, which is the acquisition date, we will determine goodwill. And something just slipped my mind now. Determine goodwill. Okay, I'll come back to that. So what's important, we determined the acquisition date. We determined that we have control, and that means we have to consolidate, and that we have 75%. Very, very important. Remember, at the acquisition date, we apply IFRS 3. IFRS 3 says when you have to apply IFRS 3, we must use the acquisition method. The acquisition method has 4 steps. Number 1, in no particular order. Number 1, identify who is the acquirer. The acquirer is the one that has control over the other. So because ABC have control over DF, ABC is the acquirer. Number 2, we need to determine the acquisition date. The acquisition date is the date when we gain control. In this case, it's 1 March 2018. Now, those two are generally going to be very straightforward for us. In the real world, it may not be as straightforward. Number 3, what they'll test us quite a bit on is that we have to measure assets and liabilities at the acquisition date fair values. Okay, so all assets and all liabilities, we have to measure at the acquisition date fair value. And then number 4, at the acquisition date, we determine goodwill or a bargain purchase gain. Okay, so very important. Now, the next sentence says the purchase consideration for the acquisition was payable to the previous shareholders as follows. To work out goodwill, the formula we shared with you is goodwill equals consideration plus NCI minus the fair value of net identifiable assets. That will equal goodwill. Now, to get the consideration, there's a number of things that can make up the consideration. For NCI, we said NCI can be measured in two ways. Um, Either at the acquisition rate fair value or at their proportionate share of the net identifiable assets. So that's the two ways NCI can be measured. And then thirdly, we need to determine the fair value of all the net identifiable assets, and that is assets minus liabilities. So that is, just take note of that. Here, they're giving us a number of things relating to consideration. Basically, what they're giving you over here is every possible way that someone can pay for an acquisition, at least from what we need to know. There are more other stuff, but what is within the scope for our testing, this is basically everything that can be included in the consideration. Remember, the consideration includes anything that you transfer in exchange for the subsidiary. Okay, so just take note of that. So here we go. They're telling you that the acquisition includes a cash consideration of 610,000 Rand was paid on 1 March 2018. Okay, happy with that. A cash payment of 155 will be transferred on 29 February 2020. What's important to note, we want the consideration that was transferred as at 1 March 2018, the date of acquisition. So the first one, that 610, is at the date of acquisition. The other one, 155, that 155 will only be transferred in 2 years' time. So therefore, we need to get the present value because we need the value today. Okay, very important. Then they say ABC issued 5,000 of its ordinary shares to the shareholders of DEF. The fair value of the shares was 58 Rand on 1 March 2018. The fair value increased to 60 Rand per share on a registration date of the share, which was 18 March 2018. Now we need to get the value of the shares, which will also form part of the consideration. To get the value, we're going to say number of shares times share price. They gave us 2 share prices. We need to decide which share price is the appropriate share price. But now remember, you need to think, you need to apply rationale. We need to determine the consideration at the acquisition date, and that must guide you in determining what the share price is. Then the next one is a performance clause was included in the purchase agreement whereby ABC is obliged to transfer an additional cash consideration of 150,000 Rand on 31 August 2020 if the revenue of DEF for its 2020 financial year is 30% higher compared to the 2018 financial year. The fair value of the additional cash consideration was estimated to be 60,000 on 1 March 2018 and 45,000 on 28 February 2019. The revenue of DEF had increased by 14% in the 2019 financial year. The changes in fair value of the additional cash consideration is as a result of post-acquisition date events. Okay, so that item over there, that last bullet point, that is something known as a contingent consideration. So what could happen is you and the previous shareholders may have an agreement. So you are ABC, you want to acquire DEF. As part of the consideration, you and the previous shareholders agree that if a certain revenue amount is achieved, we want extra cash. Because maybe you came up with a cash value, you came up with a consideration price, and you maybe disagreed in terms of what the revenue would be. So in order to play it safe, you guys came to an agreement to say, okay, you don't have to pay us the 150 now. But in the event that you do reach a certain target, then you must pay an additional amount. So that is what they are telling us over here. If at 31 August, the revenue increases by 30%, then we as the previous shareholders want an extra 150,000 Rand. Now that is a contingent consideration. Why the word contingent? Because it is dependent upon some uncertain future event. Okay, so it's considered a contingent consideration. The word contingent means it's uncertainty. So therefore, it's a contingent is got to do with an uncertain future event. What is the uncertain future event? We're not certain whether in a few months' time we're going to reach a target of 30%. But if that do happen, we will have to pay that people, the previous shareholders, an extra 150. So at the date of acquisition, we need to determine some fair value number, and based on whatever method they apply, they came to an estimate of 60,000 Rand on 1 March 2018 and 45,000 Rand on 28 February 2019. You need to decide which one is the appropriate value to include in your consideration, in your total consideration transferred. Now, I was going to read this last two. So they say, in accordance with the purchase agreement, ABC also transferred a machine with a carrying amount of 250 to DEF on 1 March 2018. The machine had a fair value of 225,000 Rand and a remaining useful life of 4 years and a residual value of 5,000 Rand at the date of acquisition. So once again, you will have to have a look what you will be including in the consideration price. Okay, so remember, you will always include the fair value. You need to determine what value is the fair value. The loss is as part of the cash consideration of 610,000 Rand paid on 1 March 2018. ABC also incurred legal costs of 15,000 Rand. So remember, included in the 610 is the 15,000 Rand, which was paid directly to the assisting attorneys. ABC paid share costs of 10,000 Rand directly to the stockbroker on 18 March 2018, which was the registration date of the 5,000 shares into the name of the previous shareholders. So what you must know, legal costs should not be included in the consideration. So legal costs should not be included in the consideration. Included in this cash consideration of 610 is the legal costs. So we'll have to make some form of an adjustment. Oh, sorry, I read wrong. Apart from the cash consideration of 16 paid on 1 March, ABC, oh, sorry. Oh, okay, yeah, so just take note. Okay, so sorry, I read wrong. So apart from the cash consideration of 16 paid on 1 March 2018, ABC also included legal fees of 15,000 Rand, which was paid directly. We do not include legal fees in the cash consideration. Now take note, in another question, they could have said included in the 610 is legal fees. So just pay careful attention. I read wrong over there. And then here with the ABC shares, so share costs you can include. Okay, so the way you will deal with the share cost is how they deal with it in terms of IS32. When we attempt this question, I'll take you to IS32 and I'll show you, and we'll read through the paragraph to see how we need to deal with it. So I'm not going to go on further. I'm going to ask you just to use this information over here. Just to use this information over here and come up with a consideration. I'm going to give you 10 minutes. and then I'm going to, no, so I'm going to give you 8 minutes. So by 7 o'clock, I'm going to stop you. And then you're going to take me through it. And then we're going to try to determine the cash consideration, the consideration transferred. Just as to give, before you get into it, the cash consideration transferred is the fair value of everything that you transfer to the previous shareholders. So that includes cash, that includes any other assets, that includes equity instruments, and that includes any liabilities that you assume. Okay, it can also include a business you transfer, but that is not for our purposes. So using that, so we want the fair value at the acquisition date that is included in the consideration transferred. So it is um, cash that you transfer, any other assets that you transfer, equity instruments that you transfer, and any liabilities that you may assume. So if you can take from now till 7 o'clock, just try to come up with something. Just see whatever you can come up with. I list each line separately and then get a total a total consideration, and then we will go through it together. So I'll give you till 7, and then I will help you through it. Okay, guys, are you guys ready? So I'm going to set it up now, and then you're going to take me through the cash, the consideration transferred. Okay, you should see Excel. So we're going to work out consideration transferred. Consideration transferred. Okay, so I'm going to go first, and I'm going to say included in the cash consideration is cash paid, and that is 610. 1, 2, 3. So I did my part. Now each of you are going to do your part. Okay, who wants to go first? What's the next thing you include and what amount? Who wanna go first?
I included the 5,000 shares at 58 Rand
Okay, so we're gonna
on
have
1 March
equity
2018.
instruments, and you saying 5,000 times 58 Rand. So why 5,000 and why 58?
Because that was the issue price at 1 March 2018. It's on
And
the acquisition date.
what the 58, and what was the
Yeah,
5,000?
that was shares issued to the shareholders of the.
Okay, so remember, why are we including the cash paid? It is because included in the included in the consideration transferred, you include cash, any other asset, equity instruments, and any liabilities assumed. Okay, so okay, so the cash paid I included, and then the issued shares. So they gave us two amounts: an amount, the registration date of the shares, as well as the acquisition date of the shares. So we use the share price based on the acquisition date, and that's the 58 Rand. To get the fair value of 58 Rand times 5,000 Rand. Next, what include any want to go next? After this, I'm going to select. So someone who wants to go next. Remember, here you can make mistakes. This is the training ground. You want to make mistakes here so that you don't make mistakes on the big event. Okay, so this is a training ground. So make sure you don't make deliberate mistakes, but as part of learning, you make mistakes. So you try your best. You don't deliberately now make a mistake because you hope by making a mistake here you're going to be better there. It must be a genuine mistake. So don't be afraid to say the wrong thing. Okay, so the legal fees subtracted. Okay, so the legal fees subtracted. So I'm going to include legal fees over here. So legal fees. The question is, are we going to subtract 15,000 Rand? And then the machine. Okay, so Ashita, why you want to subtract 15,000 Rand for legal fees? Rebecca, why you want to include 225 for the machine? So I'm going to give you a few seconds to respond. So you have 225. So they say in accordance with the purchase agreement, ABC also transferred a machine with a carrying amount of 250 to DEF on 1 March 2018. The machine had a fair value of 225,000, a remaining useful life of 4 years, and a residual value of 5 years, 5,000 Rand at that date. Okay, so let's quickly here, because we must include them at fair value at the acquisition date. So you can see my Excel now, right? So Ashita had legal fees. Our first one, Ashita's reasoning before I put the amount. And then we're going to have machine. And what you're going to say, 225, 123. The reasoning that Rebecca gave was we include 225,000 Rand because that is the fair value at the acquisition date. Are we all happy with that? Fakir,
Yes.
Ryan, Mahlatsi, we happy?
Yes.
Okay, so here is the one tricky part over in this case. So although you would like to include the fair value of the machine, generally you will include the fair value of the machine. But here was a subtle difference that you must take note of. When there is a transfer of an asset, like a machine, a vehicle, whatever it is, right? When there's a transfer of the asset, and that asset is going to the company itself as opposed to the shareholders. So the question you need to ask yourself, who's getting these assets? The previous shareholders or the company? If the previous shareholders are getting these amounts, then you include it at fair value. But if the assets are going to be transferred, if the assets that is transferred as part of the consideration is being transferred to the company, then you must take it at carrying amount. The reason being is we are buying the company. So when we take over the company, that asset's going to be there. So therefore, to avoid inflating assets, the accounting standard says in that case, make sure you keep the asset at carrying amount. So take note. When the consideration transferred goes to the previous shareholders, then it will be at fair value. But in the event that you transfer an asset and that asset is going to land up in the company, the subsidiary that you are acquiring, then you can't use fair value. You will use carrying amount. Why? Because you taking over that company. So in actual fact, when you take over their company, you're ending up back with that same asset. So to avoid companies, um, if I can say fictitiously, inflating asset values, the accounting standard says, make sure you don't take that fair value, but you take it at carrying amount. So this should be 250, the carrying amount. Why? So included at carrying amount and not fair value. Why? Because the asset is being transferred to the company, the acquiree company, as opposed to the previous shareholders. So how do you know this? So when you read IFRS 3, just page a few pages. Okay, maybe I'll go fetch it quickly. Let's just show you quickly. I just want to keep this open also. Let me go to IFRS 3 and I'm going to show you. So here we go. Can you see the I4S? Should be able to. Consideration transferred. So I4S 3, paragraph 37. The consideration transferred in a business combination shall be measured at fair value, which shall be calculated as the sum of the acquisition date fair values of the assets transferred by the
Can't see
acquirer.
that.
Hey? You can't.
We're still on the Excel.
Okay, I thought so you see it now?
Yeah.
Okay, so cash consideration transferred, IFRS 3, paragraph 37. It says the the consideration transferred in a business combination shall be measured at fair value, okay, which shall be calculated as the sum of the acquisition date fair values of the assets transferred by the acquirer, the liabilities incurred by the acquirer to former owners of the acquiree, and the equity instruments and the equity interest issued by the acquirer. Okay, here share-based payments. I'm going to skip that whole part of share-based payments. Examples of potential forms of consideration include cash, other assets, a business or a subsidiary of the acquirer. That part we can ignore. Consideration, contingent consideration, ordinary shares or preference share equity instruments, options, warrants. Okay, options, warrants, and member interest we can ignore. Okay, so what ones we must be aware of is cash, other assets. I've never seen a business or a subsidiary for our purposes, but it's possible. And then it's contingent consideration, ordinary or preference equity instruments. Okay, that is for us. Now, they say the consideration transferred may include assets or liabilities of the acquirer that have carrying amounts that differ from their fair values at the acquisition date. So for example, the machine, the carrying value is 250, whereas the fair value is 225. So effectively there's a 25,000 Rand fair value adjustment. If so, the acquirer shall remeasure the assets, the transferred assets or liabilities to their fair value as of the acquisition date and recognize the resulting gains or losses, if any, in profit or loss. So that is what Rebecca suggested. We having a machine, the fair value is 225, so we should the transfer should be at, the consideration should include the machine at fair value. Okay, but here they say, however, sometimes the transferred assets or liabilities remain within the combined entity after the business combination. Now they tell you how this happens. For example, because the assets or liabilities that were transferred to the acquiree rather than to its former owners. So for example, the machine is being transferred to DEF. It's not being transferred to the previous shareholders. So in the end, it's remaining in the consolidated group because it's remaining in the subsidiary. So therefore, in that case, and the acquirer therefore retains control over them. Okay, so that's right. So we say in that situation, the acquirer shall measure those assets and liabilities at their carrying amounts immediately before the acquisition date and shall not recognize a gain or loss in profit or loss. Okay, why? Because it controls both before and after the business combination. So before the business combination, it controlled it by having it in the parent. After the business combination, it's also controlling it by having it in the subsidiary. So in that case, we must have it at carrying amount. Are we guys clear on that? Guys happy? Yes, no?
Yes.
Okay. So what I can tell you, all the answers in the standard. Okay, so make sure you have some time to read the standard. It is those kind of subtleties that they will throw in. So important, who, if you see an asset that being transferred, who is the asset being transferred to? The 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 previous owners or the acquiree, that is the company you are buying. Okay, so that is the 250. So I want to see anything else. Okay, legal fees not including cash consideration. These are selling costs. Okay, because may include. Okay, okay. So Rebecca, happy with that? So you were correct in thinking that it is 225. That would have been correct if it was transferred to the previous owners. But in this case, because it's transferred to the acquiree, the company we are buying, we must keep it at carrying amount. So if we go back to the scenario, we included the cash consideration, we included um, the shares, and we included the this over here. We included the what is this now? The machine. So we must still, we spoke about legal fees. I'll comment on that now. We must still deal with share issue costs, and then there's two over here, the cash payment and the performance clause. Okay, so who want to give a try on any of these? Ryan, Fakir, who else is here? Let me just check. So Ashita responded, Faid responded, Fakir, you're quiet today. Mahlatsi, you want to give something a try? Ryan, Tandy, would you like to give something a try? Remember, this is a training ground. Make the mistakes you need to make here.
So I initially included I think you called it contingent consideration.
Okay, yeah.
In your own words.
Yes.
So I included the 60,000 on 1st March 2018, but then I realized that at the end they said the changes in fair values of the
post-acquisition. Okay. You're breaking up, Sakon. Yeah, so
is as a result of post-acquisition.
Okay, so let's go back to the standard. So contingent consideration, you are correct including it at 60,000. So you're saying you changed your mind because as said, it is a post-acquisition date, whatever. So that is something separate. A contingent consideration, because you don't know the actual value, right? You're putting estimates to it. The standard says you need to come up with an estimate. So in this case, the estimate was 60,000 Rand at 1 March 2016, but later on, their fair value changed. So they needed to tell you what that fair value change resulted in. If the fair value change resulted in a post-acquisition information, then this initial 60,000 Rand is correct. However, if that fair value change did not result as a post-acquisition information, you actually had you had the necessary information at the acquisition date, then you'd have to go back and change this. So they're just trying to tell us that what we estimated on 1 March 2018 as 60,000 Rand was correct. So that post-acquisition, that you're just trying to tell you, don't go back and change the consideration transferred, because it does not relate to any information that you required at 1 March 2018. It is information that came to light after the acquisition date. So we deal with that change in subsequent measurement. So this is correct, 60,000 Rand contingent consideration. Just because the consideration aspect of IFRS 3 is very short. So I just want to take you back to it so we can read it finish. So we read consideration, we read paragraph 37, we read paragraph 38. So here we come to paragraph 39, consideration, contingent consideration. So they say the contingent consideration, the consideration the acquirer transfers in exchange for the acquiree includes any asset or liability resulting from a contingent consideration arrangement. So like you said, you have some kind of arrangement and you're not 100% certain what you're going to be paying in future. You need to come up with a value. So they're telling you any contingent consideration arrangement needs to be included in the consideration transferred. Now they tell you how to do it. The acquirer shall recognize the acquisition date fair value of contingent consideration as part of the consideration transferred in exchange for the acquiree. Remember, the standard uses the term acquirer. That refers to the parent company. And then they use the term acquiree. That refers to the subsidiary company. The one who's doing the buying is the acquirer, the parent. The one that is being sold is the acquiree, the subsidiary. So there they're telling you in paragraph 39 that you must include a contingent consideration at the acquisition date fair value. Okay, then they just take it further. They say the acquirer shall classify an obligation to pay contingent consideration that meets the definition of a financial instrument as a financial liability or as equity on the basis of IAS 32. The acquirer shall classify as an asset the right to return a contingent. Don't have to bother too much with that. What we're interested in is paragraph 39. You include a contingent consideration at the acquisition date, fair value. Okay, so are we happy with that? Mahlat, you fine with that?
Yes, thank you for explaining.
Okay. So you should see Excel now.
Yep.
Ryan, do you want to give me a try with that cash in advance, that cash we're going to pay in 2 years' time? Or Fakir, you quiet? Are you there?
Yeah, this is not the best module.
Okay, it's fine.
Look, Faiz, I don't want to give it a try, but because they're giving an amount in 2020, I know somehow we need to most probably work out the current amount, or
Yeah, so we
can I
need to
say
work
the
out a present
value at
value.
2018.
Yes, so we
Yeah.
need to work out a present value. So that's correct. So to work out a present value, we need to work out the fair value today, which is the present value. We're going to need future value. We're going to need payment. We're going to need N. We're going to need I. So present value, that's what we're trying to calculate. The future value, we're going to pay in 2 years' time. We're going to pay 155. Okay, so that's the future value. The payment is any fixed regular payment. There's no fixed regular payment, so that's 0. N is happening 2 years' time. We are at 1 March 2018. The payment's going to happen 29 February 2019, which is in 2 years' time. So N is 2 years remaining. And then I. They never gave us I in the information, but generally in a financial reporting question, I, the interest rate, whatever you want to call it, the discount rate will be under additional information. So let's quickly go to additional information. Someone had a message here. Where did we get the 155? I'll go there now. The 155, there's it. A cash payment of 155 will be transferred on 29 February 2020. So we're going to pay 155 not today, but in 2 years' time. So we need to get the present value today because we need the fair value at 1 March 2018. Did that answer your question, Mahlatsi? So they never gave us a discount rate. Most likely the discount rate would be under additional information. Number 4, an appropriate pre-tax discount rate is 10% per annum compounded annually. Okay. Remember the discount rate for accounting will generally be under additional information. So I want to go over here. I'm going to include at 10%. Remember, for accounting purposes, we're always using the pre-tax because remember, tax is recorded as a separate line item. So if they gave you a before tax rate, you need to use If they gave you an after-tax rate, sorry, you must convert it to before tax. So now I can work out present value. I'm going to say equal PV. My rate is 10%. N is 2. PMT is 0. Future value is whatever, 155. Type, is it happening at the beginning of the end of the year? It's the end of the period, so I put it as 0. So my value comes to 128. So I go plug in. So I'm just going to put it here. Cash payment. So here we just make it to separate the two. This is 1 March and this is 29 Feb. 29 Feb 2020. This year relates to, it's not what the value is, that is just what the payment relates to, 1 March 2018. Okay, so the price that we're going to pay is that. Remember, we're on a positive number. The present value is always just the opposite number of the fair value or the future value. We just want the positive number. So if we go back, we can see we have covered cash payment of 610. We have covered the cash payment of 155. We have dealt with the share issue. We have dealt with the contingent consideration. So we're happy with that. We have dealt with, what is this now? The machine. And now we're going to deal with the legal fees and the 10,000 Rand. Okay. So this is how the journal entries would have taken place for that. I'm just going to put this here. Share issue costs. So let's understand. The legal fees, the journal entry was credit, bank, debit, legal fees. Okay. Credit, bank, debit, legal fees. Let's go to the standard again. So I'm going to show you where to deal with these costs. So we paragraph 53, I think, or 58 or something like that. Where did I lose you guys? I think restarted. Can someone tell me?
You're looking for paragraph 8.
Paragraph 53. Okay. Okay, so here's paragraph 53 in the, can you see it?
Yeah.
Okay. So here they deal with acquisition related costs. So this, you might just make sure you know this paragraph, write it down somewhere. And they're telling you how to deal with certain costs that you have to incur. Like for example, the legal fees, like for example, the share issue costs. So listen to what they say. Acquisition related costs are costs the acquirer incurs to effect a business combination. Okay, important. Those costs include finder's fees, advisory, legal, accounting, valuation, and other professional or consulting fees, general administrative costs, including the cost of maintaining an internal acquisitions department, and cost of registering and issuing debt and equity in securities. The acquirer shall account for acquisition-related costs as expenses in the period in which the costs are incurred and the services are received, with one exception. We'll come to that exception now. So the legal fees, the way you should deal with it, legal fees should be expensed and should not form part of the consideration transferred. So legal fees should be expensed and should not form part of the consideration transferred. If it was part of the consideration transferred, the journal entry would look like this. If the standard says you must include transfer acquisition related costs as part of the transfer, the journal entry would have looked like this. Credit bank 15,000 Rand, debit investment in subsidiary. But because they are saying you cannot, acquisition related costs should be expensed, the journal entry will look like this. Credit bank 15,000 Rand, debit legal fees expenditure. Someone asking something? No? Okay. So the legal fees must not be included. So legal fees should be 0. Okay. Just pay careful attention. In some questions, they will tell you the cash paid is 610, but included in the 610 is the legal fees. Then what you must do, you must take, you show the 610 as is, but over here by legal fees, you say minus 15,000 Rand. Now I always had that in my mind. That's why when I read it is included, but in this question, it is not included. This question, the legal fees is separate. It's a separate cost. It's not included in the 610. So because it is not included in any of these numbers, we don't want it to be included. So therefore we leave it as 0. But in another question, I must somewhere, there's another question where the legal cost is included in this cash consideration. So what you need to do is under legal fees, you must subtract whatever they included. The reason being is the standard IFRS 3 paragraph 53 says any acquisition related cost needs to be expensed and should not form part of the consideration transferred. So in this case, it is not included. We don't want it included, so therefore we show it as 0. You mustn't leave it out, because you will lose the marks. You need to show it as 0 to show them that you understand how to treat it. But like I said in another example, because it may be included in this number, you don't want it in the cash in the consideration transferred. So then you have to remove it. Then we'd have removed it over here. Okay, so we're happy with that. Any questions? You can ask me. I'm going to read on quickly to the next thing. You should see IFRS again. So they said with one exception. Here's the exception. The cost to issue debt or equity securities shall be recognized in accordance with IAS 2 and IFRS 9. So with share issue related costs, the journal entry is as follows. You paid share issue costs, so you're going to say credit bank. For every credit, there must be a debit. The debit goes against share capital. So therefore, a debit to share capital is a debit to equity. A debit to equity reduces equity. So in effect, what you should be doing, what should be happening, this equity instruments of 290 needs to be reduced by the share issue cost. So I'm going to do it over here and I'm going to say minus 10,000 Rand, because any share issue cost that is directly attributable to the shares, not legal fees, not professional fees, not registration fees, not those type of things, but like stockbroker fees, those type of costs that is directly attributable to the issuing of shares will be reduced against the equity instruments. So you will say credit bank 10,000 Rand. For every credit, there must be a debit. The debit does not go to investment in subsidiary. The debit does not go to expenses. The debit goes directly to equity through share capital. A debit to equity is a decrease in equity. So there we have it. I just want to check if we covered everything. So we went through cash consideration, we went through the 155, we went through the 5,000, we went through the contingent consideration, we went through the machine, we dealt with 15,000 and the 10,000. So they're saying ABC paid share issue cost of 10,000 Rand directly to the stockbroker. So a stockbroker, without paying fees to a stockbroker, you cannot, without paying fees to a stockbroker, you won't be able to get shares. So for example, if you invest through through Signia, or if you invest through Old Mutual, they charge you a stockbroker fee. If you have your own share account and you want to transact on the JSE, you can't directly transact with the JSE. You have to go through a stockbroker as a requirement. Well, Easy Equities, you can transact with Easy Equities, but Easy Equities is charging you a stockbroker fee because they in effect probably the stockbroker, or they're outsourcing the stockbroker into someone else. So you cannot acquire shares or issue shares without going through a stockbroker, and as a result, it is a cost directly attributable to issuing of equity instruments or debt instruments. So therefore, you must treat it in accordance with IAS 32 and IFRS 9. If you read IAS 32, they will say it needs to be reduced against equity. I'll quickly go find it so you can see. I had it open earlier, but then I came here to IFRS 3. So I'll quickly show you. So I'm going to IAS. Where is this now? So I'm going to IAS, and I'm going to IAS 32 that deals with presentation of financial instruments. IAS 32, don't underestimate the standard, very, very big standard. So do you see paragraph, IAS 32, paragraph 37? You should be able to see it now. So it says an entity typically incurs various costs in issuing or acquiring its own equity instruments. In this case, we issued our own equity instruments. Those costs might include the registration and other regulatory fees, amounts paid to legal, accounting, and other professional advisors, printing costs, and stamp duties. The transaction costs of an equity transaction are accounted for as a deduction from equity to the extent that they are incremental costs directly attributable to the equity transaction that otherwise would have been avoided. So if you did not go through by issuing shares, you did not need to pay with, you don't need to pay the stockbroker. As a result of that, you will have to, so that's why it's directly attributable. How do you treat it? As a deduction from equity. So our equity in this question is the 290. So we need to reduce the 290 by the stockbroking fees, which is the 10,000 Rand. Are we all good with that? That's so you can see where the information comes from. How do we understand that? So the consideration, we covered everything. So the consideration is equal to so the consideration is equal to that. Okay. Do you guys have any questions? Any questions? Ashita, Faid, Fakir, Mahlatsi, Rebecca, Ryan, Tandi. Any questions?
No, but
Oh,
I just want to know what question are we doing in the required?
We're going to come there now. I just wanted to cover that.
Oh, is this just an
Yeah,
extra question?
we're just me reading through the scenario, and so I wanted to show you that part. So this is effectively, we covered basically all the possibilities they can ask you for what's included in the consideration transferred. You saw there was also options warrants. Don't have to worry about that. I don't think it's included in our scope. And then a business. I'm not 100% certain whether a business and a subsidiary is included, but most likely not. So then you don't have to bother with it. Okay. I think it's, yeah, I don't think you have to bother with it. Okay. So that is as far as you go. So remember, legal fees and issue costs comes from I-43 paragraph 53. Okay. So now let's read on further. Yeah. The accountant involved in the transaction identified the following issues at the acquisition date. So the following issues. DEF had a share capital of 100,000 issued ordinary shares amounting to 100,000 Rand, and retained earnings amounted to 1.25 million. Remember, retained earnings at acquisition, very, very important. Always remember that number. Why? Because we as the parent only share in the profits from that date. So when we do since acquisition, we only want to deal with since acquisition profits from the date of acquisition. Any profits relating to before the date of acquisition, we need to remove. DEF had a secret recipe. This is like KFC. They have a secret recipe on 1 March 2018. But like with KFC, it was internally generated, and hence they won't be able to recognize it. They may be able to recognize a patent, but generally an intangible asset may not be able to be capitalized if it's internally generated. The future economic benefits from the secret recipe are legally protected. Okay, so maybe it is recognized. The expected useful life of the secret recipe is 20 years on 1 March 2018, and the fair value is 180,000 Rand. DEF has not recognized an asset in its separate financial statements in this regard. So here we're going to have to recognize an intangible asset, which is the secret recipe. Why? We were unable because DEF does not recognize it in its separate financial statements, because it most likely did not meet the recognition criteria of an intangible asset for their separate financial statements. So here's going to be an adjustment, and this is not a fair value adjustment. This is an adjustment to bring on an identifiable asset. Land with a cost of 200,000 Rand had a fair value of 300 on 1 March 2018. The fair value of the land decreased to 210 on 28 February 2019 as a result of the review of the Constitution relating to property rights. It is the policy of DEF to account for land in accordance with the cost model as per IAS 40 investment property. Okay, so there's going to be a fair value adjustment of 100,000 Rand. Okay, so we're happy with that? Yes, no? Okay, just take note. The deferred tax on the intangible asset. In a previous question, we took deferred tax at the capital gains rate for intangible asset. Why did we do that in the previous question? Because the intangible asset had an indefinite useful life. Remember, the rate you apply for deferred tax is based on how you're going to use the asset. Sorry, not how you're going to use the asset, how you're going to benefit from the asset, how you're going to recover the benefit of the asset. So if you're going to benefit from the asset through use, you use the 28%. If you're going to recover the asset through sale, then you will benefit, then the tax rate must be the CGT rate. So in the previous example, the intangible asset had an indefinite useful life. So the only way you're going to benefit through this asset is once you sell it. And as a result, the deferred tax rate we use was a CGT rate. Over here, this is not an indefinite useful life. It has a definite life of 20 years. So because we cannot recover the asset through use, that is why we're doing amortization every year for the next 20 years. We will use the normal tax rate of 28%. Please make note of that subtle differences. Then we have land, which is 300. So the 100,000, that 100,000 should be at the capital gains rate. Okay. Then they say, DEF had damaged inventory with a carrying amount of 20,000 Rand on hand at the acquisition date. ABC estimated the fair value of the inventory at 16,000 Rand. However, after incurring negligible costs during 2018, DEF was able to sell the inventory in May 2018 for 22,000. Okay, so at the acquisition date, there was a fair value adjustment, a downward fair value adjustment of 4,000 Rand, and then we will have a deferred tax implication. The fair value of shares held by non-controlling interest amounted to 16 Rand per share. Apart from the above issues, all assets and liabilities of DEF were deemed to be fairly valued, and no additional assets, liabilities, or contingent liabilities were identified at the acquisition date. Profit after tax was 375 for the 2019 financial year. Okay, so there's fair value adjustments. Before we go on, let's go look at required one. Okay, let's read the additional information. For the last bullet point, they gave you the fair value of NCI. It does not mean you must necessarily use that number, because remember, NCI can be measured in two ways, either at fair value or their proportionate share. We need to look at the company policy to see how they measure NCI. So here we go. Investments in subsidiaries and associates are accounted for at cost model. It is the accounting policy for ABC to account for property using the cost model, and for investment property also using the cost model. ABC Group provides for depreciation on a straight line basis. An appropriate discount rate 10%. ABC classifies its 10% investment in JKL as a financial asset in accordance with IFRS 9 and elected to go through OCI. Okay, I'll go talk through that again. All profits and losses of items accrue evenly throughout the year. Assume a normal tax rate of 28% and inclusion rate of 80%. ABC elected to measure non-controlling interest at the fair value at the acquisition date. So there they tell you, now we can use that 16 Rand per share. So let's look at question 1. So let's deal with calculating, calculating goodwill. Can I ask you guys to calculate goodwill or bargain purchase arising from the acquisition date in accordance with IFRS 3? How do we calculate goodwill? As follows. So we're doing part 1. So here's our workings. I'm just quickly going to put in my workings. Okay, here's the format to calculate goodwill. This format will slightly change when we come to change in ownership, but it will still remain fairly the same. So to calculate goodwill or bargain purchase gain, it is consideration plus NCI less fair value of net identifiable assets, and that will equal goodwill or bargain purchase gain. So goodwill or bargain purchase gain. If it's negative, it's bargain purchase. If it's positive, it is goodwill. We already calculated this. So there we go, plugged in. Where do I get it? I got it from working one. Can I ask you to complete the rest? I'm going to give you 10 minutes from now till 10 o'clock, from now till 8 o'clock to calculate NCI and to calculate the fair value of net identifiable assets. So I'll give you guys 10 minutes. Okay, I have some 2 messages. Okay. I'll give you guys 10 minutes, okay? Okay, guys, can we go through it now? So let's let's do NCI first. Who want to do NCI? Who want to take a stab at NCI? Anyone?
I'll do NCI.
Aye.
I'll take a shot
Okay.
at NCI.
Okay.
I think that's the easiest one.
Is I gonna get it?
Okay, so I'm just gonna go to the scenario book. So the first line there, it says DF had a share capital of 100,000, issued ordinary shares.
Yeah.
So ABC acquired 75%, so that means DF had the non-controlling assets will be 25% of this 100,000. I took 100,000 times 25%. That gives you 25,000 shares.
You just use a calculator.
Yeah, but the double check. And then yeah, at the bottom is it the fair value of a share held by non-controlling interest amounted to 16 Rand. So times that by 16 gave me 400,000.
Okay.
So the NCI would equal 400,000.
So therefore, NCI is equal to, okay. In an exam, you're going to show them this. So this is basically 100, 123 times 25%. Okay, that there is given. So NCI 400, I'm going to go fetch it, C43. So it's equal to C43, okay, 400,000. Now let's do fair value of net identifiable assets. So fair value of net identifiable assets. One person is not going to do it because it's long. So each one will get an opportunity to do a part. So who want to go first? Who want to go first? How would you go about? So how would you go about calculating the fair value of net identifiable assets? What will you start off with? And then what else would you do to get to your final number? Help me out. Who wanna go first?
Okay, I will take share price, share capital.
Okay, I just want to see quickly. It's okay, that's Rebecca. Okay, so you're going to start off with share capital
Yes, of 100,000.
of 100,000. Okay,
Then return earnings.
of
1,250,000.
okay, cool, thank you. So let me just explain what is this representing. Okay, so remember you are acquiring the subsidiary. Part of the acquisition method is to measure assets and liabilities that you acquire at fair value. Now, the accounting equation looks like this. Assets equals equity plus liabilities. Okay. we are acquiring assets and liabilities. So in effect, we're going to say assets minus liabilities equals equity. So we are actually working through assets and liabilities. Okay, we are acquiring the company and we are acquiring the assets and liabilities. Assets and liabilities, assets less liabilities, so assets acquired less liabilities assumed will equal equity. So by showing share capital and retained earnings, we are getting the net assets. But this net assets is net assets according to the financial statements of DEF, which is basically carrying amount. We need to ask ourselves, based on this financial statement, which are at carrying amount, are these carrying amounts equal to fair value? If they are equal to fair value, we need to make no fair value adjustments. If they are not at fair value, then we need to make fair value adjustments. So understand what we are doing. This two line items over here is basically obtaining assets less liabilities. It's obtaining our net assets at carrying amount. We need to check two things. Number one, are these net assets which are at carrying amount, are they at fair value? If they are, we're happy. If they're not, we need to make fair value adjustments. The second thing we need to check, included in these assets less liabilities, which we show as equity, included in an equity balance, which is representing our assets less liabilities, are there any assets that are not recognized but should be recognized? And remember, your typical examples would be intangible assets like brands, customer lists, patents, and all of those type of stuff, know-hows, and all of those type of things, customer contracts, all of those type of things. So we won't be able to, as a company, as DEF, they can't recognize it, which is most likely internally generated. However, when someone else acquire you, they are allowed to buy it because they are effectively acquiring those intangible assets. And that's where the identifiable aspect of assets come in. And then also, are there any liabilities that needs to be recognized, such as contingent liabilities? So remember, a contingent liability is not recognized on the financial statements, but rather it is disclosed in the notes to the financial statements. However, upon acquisition, a certain contingent liability, there are two types of contingent liabilities, only the one. So a certain type of contingent liability, if a company has that disclosed in the financial statements, the acquirer, the parent, as part of the group, as part of the consolidation process, or as part of IFRS 3, the acquisition method, they need to recognize their contingent liability as an actual liability. So please take note, understand what we are doing here. This share capital, that is why I told you in the previous lesson, it may not only be retained earnings, it could be mark-to-market reserve, it could be revaluation surplus. You will include all of those because all the equity will represent your net assets. Now at this point, we have our net assets. We need to add two types of things or adjust for two types of things, fair value adjustment and recognize any identifiable asset or any liability that needs to be recognized. Okay, so I hope you get that and I hope you understand the rationale. So in another question, they may not give you share capital, they may not give you retained earnings. They may actually give you the assets and liabilities of the company. Then you list the assets and liabilities of the company, which will get you to the carrying, the fair value, which will get you to the carrying amount of net assets, which is the same thing as this over here. Then over and above that, you go and do your fair value adjustments or your adjustments or your adjustments relating to identifiable assets or any liabilities that need to be assumed. Okay. So I hope we get that. Now, can someone give me one of the adjustments? So at this point, we have fair value. We have the carrying amount of the net assets, but we know there are fair value adjustments. So can someone start with the first fair value adjustment? Fakir, want to give a stab? So we already covered bullet point number 1.
Land, the land.
Land.
Yeah, so there's a adjustment on land.
Okay. So land, how much?
The fair value on the 1st of March was 300,000, and then it decreased to 210. So the difference between the two.
So what do we want? What do we want to recognize?
Are we recognizing the 300,000 on the 1st of March?
300,000 on 1st of March, because we want the fair value at the date of acquisition. Okay. So we know we want 300 because that is the fair value at the date of acquisition. So we just need to determine what is the fair value adjustment. The question you need to ask yourself, what is the current carrying amount at 1 March 2018? So remember, your carrying amount is included in this equity balance because as I explained, your equity is assets minus liabilities. So the question is, what is the current carrying amount sitting in this 1.3 million? So try to find out what is the carrying amount at the date of acquisition.
Okay.
Any idea? If you're not sure, you can tell me, then I'll help you. But first, try. If you're not sure, then you can just tell me. So what would be the carrying amount? What do you think?
I'm not sure about that one.
Okay, because land is measured at cost, the current carrying amount will equal to cost. Why? Because they're telling you that land is measured in accordance with the cost model. So, and land is a non-depreciable asset. So because there will never be depreciation on land, cost minus 0 will give you cost. So the current carrying amount is equal to cost price, which is 200,000 Rand. So the fair value adjustment is 300 minus 200, which will give us equal to 300 minus 200, 1, 2, 3, which will give us our fair value adjustment on land of 100,000. Then we will have a corresponding deferred tax. The deferred tax would be 100,000. Because it's land, it is a capital asset. We will only recover the asset through sale, and therefore we must multiply this by 80%. So we must use a CGT multiplied by 28%. Okay, so we're going to make it a negative. Why are we going to make it a negative? Because in future, we're going to pay more tax than we actually expect. So as a result, it's a taxable temporary difference, which gives rise to a deferred tax liability. A liability we show as a negative. Okay, then, so we have the first one.
Sorry, man. Just explain that deferred tax again. Why it's a negative?
Okay, so let me put it this way. So let's assume, I'm going to do it over here. This is accounting. This is accounting. This is SARS. Okay, remember the way you think about deferred tax is thinking about the future tax consequences and think of it in isolation. Think of each transaction in isolation. So for example, I'm only going to think about this land and assume there's absolutely no other difference between accounting and SARS. So what would happen? You assume so I'm going to have here, so I'm going to have profit before tax, okay? So I'm going to have profit before tax or taxable profit before tax. So accounting profit before tax or tax profit before tax. We assume is exactly the same. What was this number? 200. Okay, so I'm going to use R1 million. 1 million, 1, 2, 3. So the profit is exactly the same between SARS and accounting, except for this one item. So like we said, we isolate this example. We only, when you think about deferred tax, just think about it one transaction. So everything else is the same, but just this one transaction has a difference. So now we need to have a look regarding the tax treatment on the land. So remember, the only way we're going to get through this land is through a sale. So when we sell this land, I'm going to make up a proceeds. Okay, so when we sell, when in the future, whenever we sell this land, the proceeds will be exactly the same between accounting and SARS. I'm going to make up a number, 500,000. So proceeds for SARS and accounting exactly the same. The carrying amount or tax base, from an accounting perspective, I'm looking from the group now, right? So the accounting perspective, the tax, the carrying amount is 300,000 Rand. Because we're making 100,000 Rand adjustment. So our carrying amount is 300,000 Rand. SARS is not making the adjustment. SARS tax base is 200,000. So therefore, what is the profit on this sale? So in future, when we sell, remember the proceeds, I'm assuming. So the profit that we are making, accounting is going to expect a profit of 200,000, whereas SARS is going to expect a profit of 300,000. I just want to change this just to make it a bit different. Just make that 700. Just to avoid having similar numbers. Okay, so let's assume a proceeds is 700,000. Accounting have a carrying amount of 300, so their profit is 400. SARS also have a proceeds of 700, that's the actual selling price. But their tax base is 200, the cost price. They don't make the fair value adjustment. The fair value adjustment is an accounting adjustment from an IFRS 3 point of view. So the profit on sale of land. So remember what I'm saying. Our profit figure, we're assuming we're dealing with deferred tax. Deferred tax represents future tax consequences. So I'm saying in future, our profits are exactly the same, 1 million Rand. There's only one difference relating to this land, which is the profit on sale of the land. Remember, we can only recover this asset through sale. I'm going to ignore the 80% and those type of things. That doesn't make a difference. With accounting and SARS treat 80% the same. So we're not going to make a difference over there. So what would happen is the following. In the accounting profit, we would have 400,000 Rand. And therefore, our profit after tax, accounting is expecting profit after tax Accounting is expecting profit after tax to be 1.4 million. So accounting is expected only to pay tax on 1.4 million. SARS have a profit of 500. So SARS taxable profit or SARS profit after tax is 1.5. Accounting in future is expecting to pay tax of 1.4 million. Sorry, in future accounting is expecting to pay tax on 1.4 million. However, in future, SARS is going to charge us tax based on 1.5 million. So in future, we're actually going to be paying more tax. So this temporary difference is a taxable temporary difference. As a result, it is a deferred tax liability. And a liability we just show as negative. So that's how you think. You make up a number, you make up a profit figure. You make up a profit figure and then you show, then you ask yourself, okay, based on this one difference, what would the impact be on profit from an accounting perspective? What would the impact be on profit from a SaaS perspective? This relates to future. So in future, we must actually pay tax on 1.5 million. In future, we expect to pay tax on 1.4. So because the actual tax is more than what we expect, it is a deferred tax liability because it's a taxable temporary difference. So that is basically the thinking behind it. That's land. Ryan, do you want to take on this this recipe?
Can I go for the inventory part?
No friend.
Go to the inventory one. It's fine.
So it would be, let me just see again. So it would be the carrying amount would be 20,000. And then the fair value is 16,000, which gives it a negative 4,000.
So correct. So remember, included in this fair value of net assets, included in the carrying amount of net assets, which is represented by equity, is inventory of 20,000. We want the fair value, which is 16. So to move from the 20 in here to 16, we make a fair value adjustment to inventory of 4,000 Rand as a negative 4,000 Rand. The deferred tax will just be the opposite, which is going to be, because it's a inventory, which is a revenue asset, it's not a capital asset, we take it at 28%. Anyone wants to try Mahlatsi? Okay, Rebecca went, Ryan went, Fakir went, Faid, Mahlatsi, want to give it a try for the last one, which is the which is, what is it? Which is the intangible asset.
The intangible asset, I think I actually put it down. Let me just see. Sorry, I was still trying to understand that example you were making. Sorry. The one for how you got to deferred tax and why you saying it's a liability.
Okay. You guys must try to think about it, and then if you have any questions, let me know. Then we can try to do further explanations on it.
Okay. Okay, I'm not sure how to do this one, the secret recipe, because at first I had put in the whole fair value of 180,000, but then you mentioned that the carrying value is part of the 1.3 million, the carrying amount, I mean.
Yeah.
So I don't know how to do it.
So I'll deal with it now. Just want to get something quickly. I'll deal with it. So remember, so let's see, there's a trend.
Sorry, that deferred tax on inventory should be positive.
Yeah, positive, opposite direction. Correct. Okay. Let's see. As I know, there's a trend I'm picking up. Your initial thoughts are correct, and then for some other reason you doubt yourself afterwards and you change your right answer. Okay, so it was this one here. So you were right in the 180, and I can't remember there was another one. So go with your initial thoughts. Okay, don't second guess yourself. Like I remember a colleague of mine at Deloitte shared this once with me. And they learned it, or not learned it, it got told to them at when they did the board 2 through UJ. So some people do the board 2 exam, the board 2 preparation exam through UJ or through UCT. And one of the So the UJ lecturers, whoever it was, gave this message to them as part of like a good luck message for the exam. And it went like this: read twice, think once. Read twice, think once. Why? Why think once? After you read it twice, you should have good understanding of what you read. So whatever you're thinking at that point, just go with it, because most likely your first thoughts are going to be correct. So same with you, your initial thoughts are correct, but then you something causes a doubt and you change. So just try to pick up on those type of things. So that's like one of the stuff you must identify, that your initial thoughts are usually correct. So trust that, okay, and go with it. So the 180,000 Rand is correct of the intangible asset. Why? Remember, we said that this 1350 million represents equity. But what is equity? Equity is equal to assets minus liabilities. That's representing the carrying amount of your net assets. Net assets, assets minus liabilities. So whatever is included in those assets and liabilities is included in the 1.3 million, but at carrying amount. Now, if you read that second bullet point, they're telling you that DF did not recognize the secret recipe, and they didn't tell you why, but most likely because it didn't meet the recognition criteria for an intangible asset. So in DF's books, there's no intangible asset for the secret recipe. So included in this 1350 relating to the secret recipe is 0. We as a group, when you acquire a company, you need to recognize all identifiable assets. The secret recipe now becomes identifiable. It is now separable. So therefore they will recognize it. So we will recognize intangible asset for the secret recipe. We must recognize it at fair value. The fair value is 180. Included in here is a carrying amount of 0. We want a fair value of 180. So therefore, to get to that point, we must add 180. So remember, this equity balance represents the carrying amount of net assets. So you need to ask yourself which assets and which liabilities are included are included, and then what are their carrying amounts. That is making up this equity balance. So if the amount is included in this equity balance, then you only make a differential fair value adjustment. So for example, included in the equity balance is a land of 200. We need it to be 300, so we make 100,000 Rand adjustment. Similarly, included is inventory of 20. We need it to be 16, so we make a fair value adjustment downwards of 4K. But for the intangible assets, included in share capital is nothing. Included in the equity is nothing because they did not recognize any asset for the secret recipe. Therefore, we include the full balance, the full fair value. Now, we will go and we will calculate deferred tax. So once again, deferred tax will just be the opposite, equal negative that multiplied by the rate. Which rate do we use? The question you ask yourself, to get the correct rate, you ask yourself, how are we going to recover this asset? You can recover the asset in 3 ways. Either purely, solely through use, so you use 28%, solely through sale, so you use the capital gains rate, which is 80% times 28%, or partly use, partly sale. In that case, there will be a mixture. Then you must separate the balance. That hardly comes in our case because they removed revaluation on depreciable assets. So in that case, when revaluation on depreciable assets was still part of the syllabus, then we had that complex scenario where you needed to split between use and sale. There was one example, I can't now remember where I saw it, but I'm not going to go into it. Once we come across it, I'll show you. But otherwise, Remember, you can recover an asset in three ways. The rate you use is based on how you're going to recover the asset. Because they told you this asset has a definite useful life of 20 years. Sorry, because it told you this asset have a useful life of 20 years, this intangible asset is a definite useful life asset. So with a definite useful life, we're recovering the asset through use. When you recover the asset through use, you use the normal tax rate of 28%. If this was an indefinite useful life, that means we can only recover the asset through sale. In that case, it would be a capital gains type asset. So here we go, 28%, and we get that. We covered everything, and hence the fair value of net identifiable assets would be this. So the fair value of net identifiable assets would just be the sum so this is C54. So we're working for is equal to C54. So remember, it is consideration plus NCI minus fair value. It gives us a positive number, so therefore it is goodwill of 173,779. Okay, so that's the answer. 10 marks in the bags, 100%. Do you have any questions? If you don't have any questions, answer 2 questions for me. What did you learn in this class and what is still confusing? So let's start with the bottom. Ryan, do you want to go? You can, if you have any specific questions relating here, you can ask. If not, then just tell me what you have learned, one thing you have learned, or 2 or 3, and then at least one confusing point still. The others, you can start thinking about that response.
Okay, so what was confusing mostly was the movement in the deferred tax, whether it's a positive or negative.
Okay.
But you clarify that. That was the most concerning for me. NCI. So you say there's 2 methods how they recognize NCI or calculate it,
Yeah.
which is through fair value and at their proportionate share. So when it comes to their proportionate share, how do we calculate that? I'm not
We
sure.
calculate that. If it was their proportionate share, we just take the fair value number. So if it was their proportionate share, so I'm just going to put it here. Let's make it bold in red. Okay. If NCI was measured at their proportionate share. I mean, they say it a different way, but the way proportionate is there. Okay, proportion. I don't know how to spell proportion. Proportionate share. Okay, something like that. The way you calculate it is going to say fair value of net identifiable assets multiplied NCI percentage or interest. So so fair value of net identifiable assets, you'll always have to calculate that because you need it for the goodwill calculation. Their percentage or their interest, 25%. So we just go that multiplied by that gives them, that's there. So that's it. So proportionate share is taking their percentage of the fair value of the net identifiable assets. Does that answer your question?
Yes, thank you.
Okay. So the confusing part was deferred tax, and then anything you learned specifically?
Technically everything.
Okay.
How to go through the whole goodwill calculation. That was always a tricky question always, but you've explained it nicely. going into detail with it.
Okay. Mahlatsi?
I learned something that I think is important, how to recognize an asset for consideration. So I learned that you don't always recognize it at fair value. It depends if the asset is going to the company or it's going to the shareholders of the subsidiary. And yeah. So what I'm still struggling with is, so I understood how to decide whether an amount is a tax liability or a tax asset when we're doing the previous question, because it was just simple. There was just a tax base and a carrying amount. So you can tell from that. So today, the way you are doing it, it's a bit confusing me. So I'm not sure how to get it.
Okay, I'll do it quickly after this. Okay. Rebecca. Fakir.
What I learned is all the different type of things that gets included in consideration. There's a few new things in there that I've never seen before, especially the contingent consideration, how to handle that. So yeah, and what's still
did you come straight from third year to CTA2, or did you go through CTA1?
Straight into CTA2.
Okay, so that is why. Yeah. Okay, so it's if you went through CTA1, you will most likely have picked it up. But as from coming from third year, yeah, they don't cover that in third year. So it is something new. Okay.
Yeah. What's still challenging for me is it's maybe just a little bit confusing. That's the fair value adjustments that you need to make to get to your your net identifiable assets. So it's just I need to work through that.
Okay. Aid.
Okay, so me also, the consideration question, I only thought it was a 2-line. Just that, what is it now?
Like a cash amount.
Just that, yeah, cash amount and the shares. So I also learned a new thing. Also, what I also learned was how to recognize that vehicle. If I would have known to add the other items, I wouldn't have added vehicles, that 250,000. So that's also more new that I learned. And also confusing for me is, yeah, the fair value adjustments, especially the direction of the deferred, the tax that I would need to. Sometimes I always get, if the fair value adjustment is positive, that the tax must be in the opposite direction or whatever. So usually I guess that, but yeah, if I could maybe understand how to get the direction.
Rebecca, anything from your side? Okay, let me just see. Send a message. Most likely. Okay, so I see that the deferred tax is a thing, and the fair value adjustments. So I'm going to try to come up with some video, so forth. But before we end off quickly, let me just quickly explain it. The deferred tax on the land from a statement of financial position point of view. From a statement of financial position point of view, we'll have details. And you apply this to inventory, to everything else. Carrying amount, tax base, I will say 100% or 80%. And then I'll say DT at 28%. Just so if you don't get it right, if you don't get it yet, from for the adjustments over here. The deferred tax, where was that now? This fair value adjustment. So the deferred tax is always going to be the opposite direction. So if it's an increase, you decrease. If it's decrease, you in. So deferred tax will always be in the opposite direction. But let's understand why. Let's take land. From a group perspective, the carrying amount is now 300,000 Rand. From a tax base point of view, which is the SARS point of view, the tax base is the cost price of 200,000 Rand. So the temporary difference is 300 minus 200. Because it's a capital gain type asset, it will be 80%. So my tax, mine would be temporary difference, but I only want 80% times 28%. Okay, so remember, for your guys' purposes, you don't need to show this 180% column. I just do it, makes my life easier. So the question now is, what is this? Is it a liability or is it an asset? Is it a deferred tax asset or is it a deferred tax liability? The way you must think about it, you need to identify if it is a taxable temporary difference. If this temporary difference is taxable, it will be a deferred tax liability. If this temporary difference is deductible, it will be a deferred tax asset. I'm going to say that again. If you have a taxable temporary difference, it is a deferred tax liability. If you have a deductible temporary difference, it is a deferred tax asset. So the question comes, what is it? A taxable or deductible temporary difference? So this is how you think about it. This is how you're going to think about it. So the way you think about it is that, remember, deferred tax is a future tax consequence. Okay, so deferred tax is a future tax consequence. So you must ask yourself, in future, will I be paying more tax or will I be paying less tax? If in future I am paying more tax, then it is a taxable temporary difference. If in future I'll be paying less tax, then it is a deductible temporary difference. So that is what you need to get to. So the question is, how do we get there? To get there would be as follows. In future, accounting is expecting to deduct 300,000 Rand. So in future, they want to reduce the accounting profit by 300,000 Rand. Whereas in future, SARS is only going to reduce profit by 200,000 Rand. So as a result, accounting is expecting to pay less tax in the future because we want to deduct more. Whereas what we're actually going to be paying is more tax because SARS is deducting less. So because in future, we'll be paying more tax, it is a taxable temporary difference. And because it is a taxable temporary difference, we have a deferred tax liability. Yes, Mahlati?
Okay, I get that explanation, and that part I understand because it's the same explanation you explained the last time when we did the question. So now what's confusing me is on the carrying amount, you said land is 300,000.
Yeah.
But when we're doing the question, unless if I didn't hear you properly, you said the carrying amount for the land would be 200,000 because it's not a depreciable asset.
Yeah.
So if we said at that point that the carrying amount is 200,000, why are we putting it at 300,000 now?
Okay. So this was answering Fakir when I was answering Fakir. So we knew that the land needs to be 300,000. We needed to know what fair value adjustment we need to make to get to 300,000. in order to know what the fair value adjustment needs to be in order to get to 300,000, we need to ask ourselves, what is currently sitting in the subsidiaries books? Remember, the parent is going to look at the subsidiaries books. It's going to go through each asset and identify the carrying amounts. And then next to each carrying amount, it's going to put the fair value. So now they told us what the fair value is, 300,000. We needed to know what is the carrying amount. The carrying amount is what the subsidiary currently have in its books. Now, what is it that the subsidiary currently have in its books? It will be costs less the accumulated depreciation for PPE. For PPE, it is costs less accumulated depreciation. The cost price of the land is 200,000. Land is non-depreciable. Therefore, accumulated depreciation is 0. So our carrying amount, costs less accumulated depreciation, 200 less 0 gives me a carrying amount of 200,000. So the subsidiary currently have a carrying amount of 200,000. The group wants a carrying amount or wants the asset to be a fair value of 300. So that's how we get the fair value adjustment. Now remember, the deferred tax is from a group perspective. The group perspective is an extra 100,000 Rand. So that is basically, I hope that answers your question.
Okay, I get it. Thank you.
Okay, so I'll stop there. Now other questions. So deferred tax is we need to work on that. And there was another one, the fair value adjustments. So I have already wrote up some other notes. I just need to type it out for you guys. So I'll try to write up something on the fair value. I think I have something on deferred tax already. I'm gonna just check. But what I'm also going to be doing is I'm going to finish up this question for you guys, not today, obviously, over the weekend, is to do the rest of the required, which is B, C, and D. And then I'll send it to you guys. I'll do it over this weekend and then I'll send it to you guys. Okay, is there any other questions? If not, then we guys are good to go.
Faiz, if you are going to finish the question, will it be in a video or will you just be sending the Excel?
I'm going to do it like this, a video, yeah, with Excel.
Okay.
Yeah.
Okay, cool. Thanks.
Okay, cool.
Okay, then bye.
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 Bye-bye.
Thank you.
Pleasure.
Thanks.